Until now, you've learned the theoretical foundations of trading. In this chapter, we'll start covering the practical aspects of trading. I'll introduce you to the different types of analysis. You'll learn to analyze charts, which represents the market's movements. In order to decide where to invest and how much, you must understand the market and try to figure out the direction it will take in the future. There are two basic types of market analysis. Fundamental analysis. This type of analysis tries to predict future market movements according to a country's economic news. Technical analysis. This method analyzes current market movements in comparison to past market movements. In other words, it tries to predict future trends using past movements with the help of indicators provided by your trading platform. Fundamental analysis evaluates the economic position of countries and the ways in which economic news affects the value of their currencies and equities, or the value of the goods exported by those countries. The economic news published by a country's economists has a great deal of influence over market movements. Since the USA is the largest economy in the world, it's very important to follow it. The following is an example from the global trading market. If a poor economic statistic is announced in Britain, many traders will want to sell the British pound. In other words, the supply of pounds will increase, resulting in a decrease in the currency's value, a decrease in the value of the British pound. Another example, if a crisis in an oil-rich Arab country is announced, the price of oil will increase due to fears that the supply of oil will decrease as a result of the sensitive developments in the region. Supply and demand form the foundation of economics. To understand this principle, we need to understand that as demand for an asset increases, or as its supply decreases, the asset's price will rise and vice versa. The following is an example that illustrates this principle. Let's say a farmer has 5 regular customers. Each day his chickens lay 10 eggs. One day the chicken only laid 5 eggs, although the same number of clients wants to buy eggs. There aren't enough eggs for everyone, making his clients more willing to pay more for each egg, resulting in an increase in the price per egg. In other words, the supply decreased less eggs, but demand did not decrease, resulting in an increase in the value of the eggs. This can also go the other way around. Let's say that one day the chickens decided to lay 15 eggs. Now, the supply has increased, but the demand remains the same. In order to be able to sell all the eggs, the seller must lower the price of the eggs. In other words, the supply increased, causing a decrease in the value of the eggs. Demand is also subject to change. For example, if one day the chickens lay their usual 10 eggs, but fewer customers come to buy them, the seller may find himself left at the end of the day with unsold eggs, requiring him to lower their price. In other words, the supply remains the same, but the demand decreases, so the value of the egg also decreases. Fundamental analysis is based on macroeconomic data that is provided for that country or currency, where each country or economic bloc, i.e. Eurozone, releases a number of particularly significant and important statistics every month. These announcements often have an effect on the currency's strength. The following are a number of particularly important types of news announcements which have a particularly strong influence and usually cause very strong fluctuations in currency markets. Gross domestic product, retail sales, employment and unemployment rates, interest rate decisions, minutes from the most recent interest rate meetings, speeches made by influential figures in the market, IFO business climate surveys, PMI, Purchase Managers Index, CPI, Consumer Price Index, ZEW, Sentiment Index, relevant only in Europe. Market announcements are indicators of an economy's performance. Experienced traders know how to incorporate these announcements into their strategy. It's important to note that before an announcement is made public, forecasts for that announcement are made by experts. In many cases, the value of the underlying asset reflects the forecast, but when the actual announcement differs from the forecast, the market can become much more volatile and interesting. The following is an example which illustrates the effect such an announcement can have on the market. On April 27, 2011, an announcement was made regarding a decision taken for the interest rate in the USA. The forecast predicted a reduction of 0.25%, but in reality, the interest rate remained the same. This resulted in support for the US dollar, as can be seen with the asset's rise in value on the chart.